Hi everyone, and welcome back to another simple daily practice drill I think you can use to become a better trader. And this one's called relief bars. This is part of a series on how to improve your trading in trading ranges. This is an area that I was very weak at, and I'm happy to say it's become a strength of my trading. Here are some of the practice drills that I think help me the most. I think there's a good chance they're going to help you too.
This first exercise is one that's helpful to understand trading range. It's called exit the close. How do you play this game? Well, in TradingView, I'm going to get my little box. I've got green for buys and red for sells. I can hit control. So here's a reasonable sell. Where are other reasonable sells? Down here, consecutive bear bars down here. That's probably an okay sell. 4 consecutive bear bars, breakout, pullback, low one sell, bar 6, 2 consecutive 15-minute bear bars. These are all reasonable sells. Now, the purpose of this game is to see what happens at the close of that bar. Let's also put in reasonable buys. So market's going down, you sell anywhere in here, these are working, these are working. Let's assume you sold 8. Now, what happens to a trader on 8? Trader on 8 suddenly has consecutive bull bars up here. Okay, that's a bit of a problem. You didn't really want such a strong pullback. 2 or 3 attempts to go down. We might be having a couple of legs sideways to up. So I draw a line at that sell. And what you'll notice is that some traders bought from them. So it's reasonable that some traders actually exited out of that close. They sold late or they were selling all the way through here, and that last position, they're going to get out break even. They might take profits on the other positions. What about a trader who sold here? Well, they don't have to get out of that short position. Their signal bar's all the way up there and their stop's probably higher. What about if a trader bought here on 14? Is it a great looking buy? I don't think so with the context, but I've got to assume 4 consecutive bull bars. Probably those traders who are buying lower, they're going to make money. So I draw a line from that close and I find that's exactly where traders got out. So traders that bought there, sold there. And what this drill is doing is it's showing me if I take a trade where to get out, and if I didn't take a trade where I could possibly get in. And that made selling somewhere around here a good idea. What about traders that sold here? Well, they got 1-to-1. I took that trade, thought it was a high probability trade for a second leg. So I think those traders are okay. What about if a trader sold down here? Well, if they sold, they immediately had to sit through 4 bull bars. So I draw a line across, and what do you know? That's where traders got out of that position. So if you were short, you had a way to sell higher to get break even. And if you were flat, buying around here was actually a better idea. You see how this game works? Or what if you sold down here? You thought, okay, no 4 bear bars. I'm going to sell down there. If you did, are you going to sell here again? Probably not. Those traders that sold there are going to become buyers. So traders that bought there were able to make money. What about breakout, pullback, and a low one sell? Even if you took that sell there, that last sell, they were able to get back to that entry price. So in this exercise, we're looking at exiting the close. So you find reasonable signals, and then you look at what happened to those traders. In a trading range, this is very common. What about if traders bought up here? What happens to them? Let's say they bought that bull bar up there. That's where they could get out. So if you buy, that was a place to get out break even. And if you're flat, that was a place to sell. This is a really common behavior in trading ranges. And I think you've got to spend a lot of time practicing this drill, because as long as this behavior is present, taking trend trades are always going to disappoint. So that's exercise 1. Okay. Now let's look at the same chart and do the second exercise. What's the second drill? XHL, exit high low. This is also a failed breakout drill. How does this one work? So in the second drill, let's look at breakout trades. So we're going to look at highs and lows. So I go down here, market's going down. Here is a low. Here is another low. Here is another low. So if a trader was selling new lows, this is where their entries would be. So selling below 8 and 9, selling below 10, selling below 16. So you sell there because you think, fantastic, big leg 1, I want a big leg 2, but the market doesn't do that. So we extend those highs and lows across. This is what the second drill is to help us do. So even though I'm going to assume on the chart that the traders that are taking these trades have got wide stops, they're scaling in, they're institutions, I'm not interested in staying in that trade usually, unless it's a small position. What I am interested in is taking their exits. So traders took a reasonable breakout trade. It didn't work. We get back to their price. What happens? They get a chance to exit. Easy. Okay. Now let's look at another breakout. For the bulls, it's counter trend, so it's going to be a little bit more difficult, but still possible. New low, potential double bottom. What about up here? Traders deciding on this bar. I think we're going to have the low of the day, lots of bull bars. We're going to drift back up and form a trading range. Okay, well, if you do that, your buy entries here, that didn't work. Bang. Didn't get a new low, went all the way down there. Where's your exit? There's your exit. Are there any other highs and lows? Yeah, there's probably a high and low down there. Here we go. We've got 3 tests. We go up. Any traders that sold down here had a chance to get back out. So if you take it, take the loss and get out, scale in, get out, break even. Or if you're flat, you've got an opportunity to get into a trade. So this is drill 2, exiting at highs or lows. Now, you can also see that I've used fairly obvious swing point. What's an obvious swing point? Well, obvious swing points look like this. It's very clear, but each bar itself can be a little swing point. So even here, traders buying above that breakout point, saying, I think we're going to get a measured move up, it instantly fails because it's a minor swing point, and you could argue that it's available on every single bar. It's not as reliable to get back to, but you can take this technique, put it on lower time frames and higher time frames. Although I wouldn't recommend doing it on every bar because I think you'll just get mentally tired as you're trading. Okay, so now let's think about drill 3. 3 is trends. So rather than starting with a trend and asking what's a trading range, we've been practicing on trading range days, and now we're going to look at trends. So you can see I've picked a day that's drifting sideways to up. Why am I doing this? Because I want to see this behavior. I want to be able to do drill 1 and 2 again on a trending day and see what happens. On the prior day that we looked at, practicing those drills, it looks very easy. We always come back to those signal bars. But one definition of a trend that's useful for trading, I believe, is that one side is making money or getting out break even, and the other side at best is breaking even or can only lose money. So let's practice drill 1 and 2 on a trend. So first drill, exit the close. So for trader sold the close here, or second entry short up here, or 3 or 4 pushes up, let's say they sell somewhere here, strong spike, pull back, low one sell, selling somewhere down here. Let's also take the sell, any of these sells from the day before. So I'm just looking at bear bars at the moment. And I know we're in a bull trend, so I'm expecting these traders to lose money. Let's see what happened to them. Could they get out of that trade? No. Could they get out of that trade? No. Could they get out of that trade? No. Could they get out of that trade? Yes. Yes, they could get out of that trade. Could they get out of this trade here? Yes. So these sells, we went far away from the price and we never came back to. These sells, well, okay, traders were able to sell high and make money if they sold low. Why is this considered low? Well, I think it's reasonable. We're breaking out of the high of yesterday. If I put that on the chart. So selling back at that price, it's probably support. But interestingly enough, these traders were able to get out. I'm not suggesting that you have to hold that trade. I'm saying if you sell, you exit. But if you were to sell later, that's your target. Now, because traders are able to sell high and sell low and get out break even, we know if we keep playing this game that we're going to be able to see that all these bears are going to be able to do that. So by looking at the side that's losing in a bull trend, that's got to be the bears. That's the only way we can keep sloping up. I can see where it's very bullish. So it's very bullish here. The moment these traders sold, bang, bull breakout, bull breakout, bull breakout. So if you have to choose what side to take, you want to be a bull. So buying the moving average here was a good trade. Buying after this bear buy was a good trade. Seeing this spike, buying anywhere in here was okay. But as soon as you see this price action, where we're coming back to test those bear entries, now it becomes more 50-50. Traders are able to buy and buy lower. Traders are able to sell and sell higher. So we get this view before these traders can get out break even, the market is trending, and I either want to be on the side of the trend or flat. The moment these traders are able to get out break even, it becomes more 50-50. And that means rather than just looking for trades in this particular trending direction, traders were able to use those trap traders as targets. So what we think a vacuum move is really a test of those trap traders. When the market is trending and one side is clearly losing, we call this a breakout, strong breakout. When traders are able to get out break even, we call these vacuum moves. Let's have a look at this same day, but from the purposes of drill 2, looking at highs and lows. So a trader buys a breakout to a new high. Well, it's a bull breakout and it's a bull bar and we're above both moving averages. Sure, that's a buy. Here's a buy. If a trader waited for the breakout and a pullback, the old breakout retest, that's also a buy. They even had a third chance to buy. What if a trader sold above that high? Well, I don't think it's a great idea, but those traders that sold were able to get out break even back here. Let's look at a new high of the day. What if a trader sold up there? Did they lose a lot of money? No, they were okay. So by using these two techniques together, it's giving me an indication, well, buying new highs was good here. Now it's not so clear. So we're probably in a channel. So even if traders sell above that price, we're probably going to come back and test. I'm not recommending you do that. I'm looking at what other limit order traders and institutions are doing. I think it's too bullish, but it's interesting to see that we did come back and oscillate around that price. And for the purposes of the drill, if you bought a new high of the day with a wide stop, we come all the way back, but don't stop you out. What do you do at this price? You had an opportunity to exit break even. If you bought the new high of the day, you get disappointed by this huge pullback, you were able to exit break even. So there are the two drills on a trending day. Let's look at a bear trend. This drill should become much easier for you now as you start to adjust your eyes to what's happening. If a trader bought the close there, we came all the way back up to that price to sell from. If a trader sold all the way down there, remember, I'm not saying you have to take these trades. I think they're actually better when you're flat. Now watch what happens here. Traders that are buying, we come all the way back up to let them out. Traders are selling, we come all the way down to let them out. But what happens at this price? If a trader suddenly bought there, are they able to get out? So this buy here is for these bears here. They sell higher, they get out. What about new bears? So any bears that sell in here, they're short. And what happens to the bulls that bought this bull bar here? They are not able to get out. So bears are making money. Okay, and then what happens to bears? They're able to sell, sell, sell. They can sell in here. They can sell in here. So here is a transition point. And I think practicing this drill is going to help identify these kind of transition points. You can also call this a breakout and follow through and a breakout gap. Now we have a gap, many ways to draw it, between that low or between this low. But there's definitely a gap in there. I'm using the gap to the close of that bull bar because if we go to the left, reasonable in a channel like this that's going sideways, finding buyers below prior lows. Look at the buyers. But at some point, that fails. So if you bought there and took a loss, now that's going to turn into resistance most likely. So at some point between here and here, in this 60-minute range, the market is shifting into something different. Traders are not able to buy below things and make money easily. This went very far against them. 14 or 15 points against them before it got back to their position. At some point, the bulls are going to buy again and be able to make money. If traders bought anywhere in here, not a great idea in a bear trend, but there has to be traders buying. If you've got 1, 2, 3, 4, 5 bull bars, traders buying lower, able to get back to that price. Trading range, trend, trading range. This is a different way to look at when the market is changing. Of course, it's going to be easier in hindsight when I've got the whole chart, but this is what I'm thinking about as I'm trading. Are bulls able to get back to their entry bar? No. No. Yes. This is the first time the bulls have been able to get back to their entry bar. You might even say in here, well, technically they bought and were able to get back to it there. But here they were actually able to make money from that price. And that's how you can practice it in a bear channel. Trading range, transition to a trend, transition to a trading range. So part of the decision-making process, I've got to ask myself when the chart is building. So I'm going to play the chart here. I'm playing it on slow motion, or really fast motion, but if a trader bought that bull bar up here, what's happening to them? Traders that sold anything down here, they're okay. Traders selling here, what's happening to those traders? There's nothing to buy, so traders are selling or they're going to sell harder. So even though I'm flat, I'm looking at what's going to happen to those traders. How will I manage that position? So will these bears are short there? What about if a bull bought in there? Not good. So we've got a parabolic wedge. We're starting to form a trading range. So I can already tell, even though these bulls weren't able to buy up here and make money, that's drill one using buy the close. Remember, if I'm using prior lows, traders that bought below that low and bought somewhere below were actually able to make 10 points. So drill one, use the close. Drill two, use highs and lows. The reason I separate these drills is because what you're going to find is you're going to have a lot of lines on the chart. You're going to be asking a lot of questions, and that's going to take a lot of mental load to do that. And the result is typically hesitation or just poor trading. And in this example, adding these slowly is going to show you how quickly you can get complex. So at the moment, what do I think is going to happen? Well, traders that were buying below things were making money. I think they're going to continue to make money. And eventually traders that buy the close of a bar, particularly this one that triggered, we're probably going to get back to that price. What happened there? So the pattern was traders buying below. Eventually traders were able to buy the close and get back to those bars. Trading range price action. So we can still go lower, but now this is showing us the traders are able to get out break even. If traders can get out break even, what are they going to do? Well, they're going to take smaller positions on the first position more likely and expect to have to scale in. And if they can't scale in, they'll probably have to add on higher. So that's an example of how you can use that drill, particularly if you can do it during market replay to build skill. Now, when you see the chart, okay, here's a bear spike, traders sold above it. Disappointing. We came back and other traders bought there. There's a scalp. It's another way you can use it. Well, I hope you found that valuable. Thanks very much for watching. In this video, I talked about day trading practice drills for trading ranges, relief bars, support resistance, and gaps. I talked about 3 drills. Drill 1, exit the close, practicing in a trading range. I've got more notes about this technique on my blog at zentradingtech.com. The 3 drills, drill 1, XTC, exit the close, find a sideways day, and look at what happens to those traders. This will prevent me from always buying the breakout bar if I look to the left and see that other traders were stuck there. That's drill 1. Drill 2, XHL, exiting at higher lows or failed breakout. Traders who are selling a new low get disappointed, probably going to exit that position there. Comes a place you can buy. Traders who bought the breakout, it fails. We go back up there, there's probably a sell there. And then drill 3, practicing that technique on days that are trending in either direction. When can the traders get out? When can't they? Here's a bull trend. Use the close, use highs and lows. I would keep it separate until you can do it without getting too confused. And a bear version. Up here, traders were able to get out at those prices. Once again, I'm not saying you have to trade this way. I'm watching to see what happens at that price. You manage the trade according to your trading plan. The trading range here, where does it start? Where does it end? Well, when can traders save their trades? When can't they? Bulls were not able to save this trade there. That happens to be the start of the trend. Bulls were able to save their trade here. That's the start of the trading range.
Well, thanks very much for watching. I hope you found that valuable. In this video, we talked about relief bars and drills that can help you improve your trading in trading ranges. My name's Tim Fairweather, and I'll see you in the next video.